Good evening, everyone. Welcome to the first quarter HMB investor presentation. So first we will have the presentation. Priyanka, AGM Strategy, will do the presentation in about 10 minutes. And thereafter, I'll join Priyanka for the Q&A session. Over to you, Priyanka.
Thank you, Rajiv. Good evening, everyone, and thank you very much for joining our earnings call. So I'll try to take you all through the update within about 10 to 15 minutes. Moving into our income side, first of all, I'd like to take you through what happened during the quarter over the past 12 months. So as you know, interest rates have been moving up since September last year. So compared to where PLR was in March 2021, it has increased by about 400 basis points up to end of the first quarter. But since then, as you know, with the increase in policy rates in April, PLR has moved up to about 21% now. Apart from that, as you know, with the exchange rate being floated, exchange rupee also depreciated to about 300 from 200 as at end of the first quarter. So in that background, you can see that advances have gone past 1 trillion, growing by 9%, and the deposits have increased by 13%. This growth partly is through the currency or the exchange impact. If you look at our NII, you can see that our NII has grown by 54% from first quarter 2022. And you can see in the third graph that we've shown here, with the rates moving up and the assets getting repriced, assets as well as deposits getting repriced, you can see that margins have improved significantly from what it was end of first quarter of last year. Moving on to fund-based income, you can see that fee income has grown significantly by 36%. So this has been contributed by the growth in trade income, growth in card fees, because with the increase in volumes during the first quarter compared to what we saw in the first quarter of 2021, card volumes have also increased. And we see that with, as I mentioned earlier, with the rupee being depreciated, we saw an exchange gain of 7.3 billion in the first quarter. Also, our insurance premium has increased by 30% during the first quarter. If you look at our asset quality, as at end of first quarter, you can see that our stage 3 loans, net loans, have come down from what it was as at end of last year. So from 2.55% as at end of December, it has improved to 2.4%. Nevertheless, considering the elevated risk and economic conditions, we've made a provision of 6.8 billion on account of loans and other contingent liabilities for the first quarter. Also, as you know, with the central bank making the announcement to suspend foreign currency external debt and the subsequent downgrade of the sovereign, the entire banking sector followed the same approach, and accordingly we made a provision of 6.7 billion in the first quarter on account of our investments in SLDBs and SLSBs. On top of that, there is another impairment charge that we've taken into account based on the exchange impact on our investments in SLDBs, SLSBs, as well as the loans and advances. So that that impairment has been set off against the exchange income. Moving on to operational expenses, you can see that I think you've seen the same growth across the industry, especially with inflation going up. The costs have increased. Personal expenses have increased because every 3 years we have a collective agreement, and with that, the executive salaries also have got revised. But with the income growing at a faster rate than the expenses, you see the cost to income ratio improving to 25%. That's for the bank, and for the group from 48%, it has improved to 35%. Moving on to taxation, with the VAT rate increasing from 15 to 18%, and also with the income that we get from our investments in foreign currency denominated government securities coming down with the maturities, we see the income tax expense going up slightly. So our group PAT as at end of the period has grown by 11.5% to 5.4 billion. So our capital adequacy levels have continued to be above the minimum requirements. As at end of the first quarter, our Tier 1 capital was at 12.2% and our total capital was at a 15.6%. Recently, Central Bank has allowed the banks to draw down up to 2.5% on account of the capital conservation buffer. So this is a new development. Plus, the LCR requirement, which was at 100%, has also been brought down to 90%. So as at March, if you look at it, we've been well above these limits. Moving on to the DuPont, you can see, as I mentioned earlier, our income both on account of NII and other income has seen a significant improvement, but this improvement has been taken over mostly through impairment and partly through the increasing operating expenses. So I will stop at this and we'll be happy to take on any questions that you may have.
Go ahead, Hafil.
Hi, yeah. So just
Your hand is.
yeah. So I just happened to look at there was this scope committee meeting where SLIC was grilled, and there was some comments was made about HNB that they said that they don't have, bank does not have dollar liquidity to meet their premium payments. Just want to get some clarification from you on that.
Sorry, I think I missed the initial part of the question. Hafil,
So
can
yeah,
you?
so there was a certain sorry, excuse me, certain recordings on YouTube of the recent COPE committee meeting in Parliament, where SLI Sri Lanka Insurance Corporation was asked about their certain investments, and then they had, I think, apparently had some dollar deposits in BOC and HNB, and I think the CFO was saying that they don't, that the two banks don't have dollars to give them to make their reinsurance premium payments. Just want to
I
get
think
your clarification on that. Is it correct?
I think the same clip he re-clarified, saying that it's not HNB, it's BOC, and that there is only 100,000 or some small amount. I remember him mentioning that is in HNB.
Yeah, thanks. Just to add one more, just one more thing, if I may add. Now, just this is a completely different question with regard to, say, your collateral, right? I mean, like, how? I mean, like, have you all done any stress test to see that, if, say, NPLs are to increase, or if the loan book does go bad, say what percentage of your collateral can be recovered in, say, I mean, I don't want to use the word fire sale, but like in a stressed situation. Have you all done any tests like that?
So I guess we when we look at our loss given default and the calculations on loss given default and the back testing, all that usually happens through looking at how well we can recover, whether we have been able to recover our collateral in the past, and based on that only the calculations on impairment happens. So I believe more or less your I think your answer gets covered there. Of course, we are also into unknown territory right now. At the moment, if you look at our NPA ratios and more than NPA, I think I need to call it the stage 3 ratio. You can see that we probably have one of the best in the industry. But of course, with the current economic situation, asset quality can come under stress. So yes, we look at various computations and permutations, but it's more about trying to figure out how well we have been able to liquidate our collateral in the past and what is our experience, and that is what will then feed into our impairment models. Of course, in addition to our past experience, we will also bring in various economic factors also into that to bring in more forward-looking projection or prediction also into that calculation. I hope I was
Yeah.
able to answer your
Okay.
question.
So we can see this calculation. Would it be in the second quarter, or is it something further down towards the financial year?
So no, so we have we do it, and each quarter, each year, our impairment calculations or the credit loss that we take for each product depends on these calculations, and it keeps on getting refined. And I think even especially in the first quarter, there were a lot of adjustments done to the economic factor, and there was a fair amount of impairment that came through the stress that we have made on economic factor adjustment. So that's done. It continues to happen, Hafil, as
Sure.
you go on.
Right. Thank you very much. Thank you, Rajiv.
Hi, Rajiv.
Hi, go ahead.
Yes, just few questions on the impairment side. So I think one question was out right now. What will be the total management overlays that the bank has taken from 2020 to right now? What will be the accumulated number?
So we have around 8 billion in management overlays overall.
Okay, thanks. And I think last time in when we asked this question, the PDs and LGDs, I think PDs was 30% and in this quarter, how has this changed and whether the this has already
Yeah.
been
So what has happened is now it's not a straightforward answer in terms of PD and LGD because we have moved from stage 1 to stage 2 on the ISB. So what I can say is overall impairment ratio, I saw another question here also, has increased to 12.5% on ISBs, that is international sovereign bonds, from around 7% that we had earlier. So, but the different LGDs and PDs will differ from issue to issue because it's now gone into stage 2 and a lifetime impairment calculation. So roughly, specifically taking out the exchange impact only on the increase in LGD, PD, and economic factor for SLDBs and ISBs, we have taken about almost 7 billion impairment for the first quarter.
Thanks, Rajiv. Thanks. For the clarification.
Hi Rajiv, it's Ramali.
Yes, Ramali.
Just had a question on the finance, your finance subsidiary. What would you be able to give us a sense of the asset quality as at now, and also whether there would be any plans to capitalize the finance company this year?
So the asset quality has been improving for some time. I think they were having a fairly bad time maybe a couple of years back, but it's improved fairly significantly. But in the last quarter, or maybe the last 2 months, we have probably seen that improvement kind of getting stifled, and it's kind of starting to slightly increase. But it's still compared to maybe 12 to 18 months ago, I think they've been able to improve asset quality by almost, I would say, uh, 600-700 basis points. So that's been good. But then, of course, we are mindful about the current situation and how that can impact. But they've been managing it quite well so far. A lot of aggression, lot of focus on collections because they faced a difficult time, and there's that momentum is continuing in terms of collection. So you would also know that they just went through a merger with Prime Finance. They just completed it a couple of weeks back, and that was one of the quickest mergers and integrations that probably this country has seen, and it's been very successful. So based on after the merger, we will look at the capital position, and then we'll see whether they need additional capital. And if they see there is a requirement, then we will definitely look at that, Ramali.
Okay, thanks.
So there is a question about the new relaxation on capital rules. I think Priyanka touched during her presentation that banks are allowed to draw down 2.5% from the minimum capital ratios if they require. For the moment, we are well above the requirement, but if there is, then we will consider drawing it down. For the moment, we don't require it, but if we require, we will definitely look at that option. In addition to that, they have also allowed the mark-to-market impact from interest rates increasing to be spread out over a period of 3 years. So that's also another relaxation that was given in the recent direction. Of course, this is not a significant impact to us as compared to some of the other banks because most of our investments were were in the short end. So we have not had significant mark-to-market losses coming through our OCI. So there's a question on HMB's current exposure to SLDBs and ISBs. ISBs is about $530 million. SLDBs is about $100 million. There is a 5 billion increase in other borrowings. I'm not sure which, this is the foreign currency impact. Yeah, this is the foreign currency impact because of the depreciation of the rupee. The dollar borrowings that we have, there was increased by rupees 5 billion. So I probably don't understand this question. Maybe whoever asked can probably clarify. Would you go ahead and adopt the mark-to-market loss absorption? If so, would it be done starting from Q2 or Q1? This is OCI. This is the asking on the central bank. So we will spread it out. We will take the concession. So SOE exposure is minimal. We have not lent to SOEs. We have done some lending to road development and water board, but those are under a sovereign Ministry of Finance guarantee. So what percentage of deposits and loan growth is driven by FX? Priyanka, you have the... So for a normal growth, taken out exchange is about 4% roughly for both deposits and advances. Moratorium is under 3% at the moment. So what is our outlook on the rates? Well, currently, I think even yesterday's auction, the indication is that rates would stabilize or central bank wants to bring it down. But of course, the fundamentals still don't indicate that there be a possibility of bringing it down effectively, especially with the government saying that they need more rupees to pay salaries, and still we haven't seen some of the foreign funds from World Bank, IMF, ADB, those coming in. I would expect rates at least to stay at these levels for some time till we see some clarity on the negotiations with IMF. But very difficult to predict at this point in time because there are a lot of moving parts. Murad, your hand is up.
Thank you, Rajiv. Thanks for the presentation. I had a few questions on first a simple one. I mean, you mentioned impairment of about 12.5% on SLDBs and ISBs. So is that fair
On
to assume that?
ISPs, Murad, it's mainly on ISPs, 12.5.
Okay, so you haven't taken provisions on SLDBs?
SLDBs is around, I would say, 8% at the moment.
8%. And this factors, it does, this. So would it be, should we be looking at further provisioning when the Q2 results are out on ISBs, given that now that there is a technical default announced?
So we will look at it. Of course, on the SLDBs, we can opt rupees, and hence there is like the impact or the necessity to have a higher impairment on SLDBs would be slightly lower. ISPs definitely will look at it. Again, ISPs also, the circular says that you can opt for rupees, but I think until there is formal negotiations that happen, that may take a bit of time for them to really come up and give a solution. So therefore, we will look at whether there is a necessity, and if so, you might see some increase in impairment on especially the ISBs over the next few quarters.
So on SLDBs, you can consider conversion into and repayment in rupees if
So
if that's
we
the case.
can, and we have recent maturity, we were able to get rupees, and then we managed to buy dollars and cover our position with those rupees. So that was already done with the latest
Okay.
maturity that happened.
Okay. And just to confirm, both SLDBs and ISBs are booked in your overseas banking unit balance sheet, right? So there's
It's booked
no
in
foreign
both.
currency.
It's booked in both, Murad. It's booked in FCBU as well as the DBU.
But majority would be in FCBU or?
No, majority would be in DBU.
Okay. All right. On ISBs, you had previously mentioned that your base case in terms of, what happens is possibly a term extension or a restructure and an extension in the term of the repayment rather than an upfront haircut being asked to take. And you're still holding that view? And I know it's premature given that I'm sure that the minister and the government is working on a restructuring plan, but any idea, any work at your end on how big that impairment could be if term is extended?
It's difficult to say, Murad, at this point in time. I think we are also not clear whether there will be a haircut, but most likely going by our SLDB experience in terms of getting rupees. I think if you are willing to take rupees, probably the haircut might not be there or will be lesser is what we believe. But we'll have to wait and see. It's very difficult to mention anything. I think things are more blurred right now than what it was earlier. So because you need to see what's happening in other countries, how has these negotiations happen, what has IMF insisted. So I think none of us really know the full story, what has been the negotiations with IMF. So without that, it's a bit difficult to really mention anything at this point in time. But again, I hold on to my view that if you're willing to take rupees, probably you might not have any haircut or it'll be significantly low, is the view that we hold right now. So we'll have to wait and see how it goes.
Sure. One question on capital adequacy. So, just wanted to understand check if my understanding is correct. So, all your capital is denominated in Sri Lankan rupees, and the FCBU, whenever that gets adjusted, obviously based on the currency movement, your risk-weighted assets in rupee terms would increase, and hence, even if nothing happens on balance sheet side in terms of growth, just the rupee depreciation would mean that risk-weighted assets would go up and your capital, because it's local currency, would stay same, and hence capital ratios would fall.
Yes, so that's right.
And this is partly what we've seen in the first quarter numbers as well.
That's right. So it's partly with the capital. So first quarter, I think there were a number of reasons. One is because the rupee depreciation, your risk-weighted assets went up. In addition to that, in 2021. With COVID, central bank had allowed to take only 10% risk weighting on the foreign currency bond investments, which then moved back to a 20% risk weighting. So that also had a fair amount of an impact on bringing down the capital adequacy ratios.
Okay. On the AWPLR translation impact. So, we've seen obviously post first quarter rates have moved up quite significantly. How quickly does that, transmit into your P&L on the asset side and on the liability side? And, we've seen improvement in margins this quarter. I mean, with this rate hike, how do you see margins going? And just a sense of how, I'm sure this is such a big increase in rates. Just wanted to get your sense on how quickly you've been able to pass it on to end customer. Is it, it must be difficult for even end customers to kind of adjust to this.
So it reflects pretty quickly in the P&L, and you would have seen almost a 50% increase in NII and margins going up to 5% as a result. So it happens fairly quickly, Murad. So now I think AWPLR has gone almost to 21%. So the margins will benefit from that. Of course, the deposit rates will also start increasing. I think the first quarter, the deposit rate movement happened fairly late. So that's why you don't see too much of an increase in interest paid while interest income had started moving. But in the second quarter, you will see both moving. But we'll still see an improvement in NIMs because you'll get the CASA benefit coming in. But of course, as you quite rightly said, though the NIMs would improve, it probably not the best for the economy. It's not even best for the banks because the same way the NIMs are increasing, it will also on the other side can add pressure on asset quality. So I think the rates are a bit too high for our liking, and we probably would want to see it much lower, though NIMs might come down because that will be more sustainable.
Thank you. And last question on related to NIMs also. I mean, it's not huge, but foreign currency, for instance, for FX loans are about 14% of your overall loan book, right? And obviously, dollar-based borrowings are at should be at much lower rate compared to what the local. So that will continue to be linked with US LIBOR or SOFR, whatever that rate eventually is, right? So margins would on the foreign book would be lower, and 14% is not much, but that would still be a drag on your overall NIMs to a slight extent, right?
Agree, Murad.
Yeah.
But
All right.
that's small compared to the overall. So
Agreed.
the way rupee rates have moved, I think probably, I think compared to probably some other banks, our rupee book would be slightly higher. So that's probably why our margins are that, as well as us being short on our investments, is a reason why our margins have probably outperformed the market in the first quarter.
Last comment, I mean, just your thoughts on deposit growth. So, over the past, during the pandemic in particular, we saw very strong growth. Given the tough economic situation that is, even when we look at first quarter growth, it was quite decent on deposit side. How do you see this now progressing over the course of the year? Is this going to be a challenge? And if deposit growth is there, I mean, is the primary allocation going to be continue to remain treasuries, in the absence of loan demand, probably?
So the deposit growth has been fairly strong, Murad. Only difference is probably with now the interest rates going up to the levels that we have seen, there is more coming through FDs, and there is a slight drop in the CASA ratio, which is understandable. So investments we'll have to see how it goes, because we will not want to be too aggressive with our loan growth. We'll want to see where we want to invest those. So the default, of course, will have to go into treasury bills or some other investment that is available. But definitely there'll be much more rigorous credit evaluation in terms of giving new loans, given the current scenario. So we'll be very cautious in giving new loans.
And just the deposits, do you still, how do you see this momentum now progressing over the rest of the year? I mean, given how the situation is obviously tough, I'm sure it's impacting savers as well, or disposable income across affect, um, how do you see this deposit growth over the course of year? Do you see this now momentum slowing over the course of year? I mean, just your sense from what you've seen in the second quarter um, up till now.
So we have seen the deposit momentum being there, Murad. Only difference, as I mentioned, is that probably you see a shift away from savings more into FDs. So
FDs, yeah.
that's something that you have seen. But definitely there'll be, we have seen steady improvement in deposits. And there is also a bit of flight to quality that might happen. So there might be monies moving from smaller banks and smaller finance companies moving to bigger banks. So that had probably also happened. And then probably some movement also happened, I think, from state banks into private banks. So with all that, I think some of the larger private banks have benefited in the last few months.
Thank you so much, Rajiv. That's all from me.
Sure.
Thank you.
Any other questions? Has anyone seen? I need to. I've been at meetings, so I have not seen these proposed tax reforms that you're talking about. Sorry about it. I might have to study it and come back. If there is any specific thing that you want to check, just let me know. I might be able to answer.
So Rajiv, the corporate tax rate has been increased to about 30%.
Okay.
I just wanted to know what what the specific impact would be on HNB. On top of that, I think there is also other tax increases on personal income tax and PAYE and all of that that could kind of have an
Has it
impact
come
on.
out officially, or this is just something that's been going on WhatsApp or?
This has come out officially from the Prime Minister's media division, actually.
Okay, okay. Right, okay. Right. So then, so 30% there'll be an increase from 24 going up. So effectively, there'll be about a 6% increase in our effective tax rate at currently our effective tax rate, I think in the first quarter was at about 36. So we'll go closer to the 40% mark and thereabout with this increase. Again, on the personal taxes, you'll see that there'll be challenges on the disposable income. So asset quality, loan growth, all that can get impacted. Again, we'll need to wait and see how much it has gone up and how it will affect and what segments it will get affected. Because especially if it's only at a very high level, then probably it might not. But if it is going across all income brackets, then that will have a bigger impact. So I'll probably need to study it a bit more.
Right. Thanks, Rajiv. Thanks a lot.
Welcome. Yes, Murad.
Yeah, sorry, just to follow up on the impairment. So you've taken about 6.8 billion in impairments for or loan-driven impairments in this quarter. Obviously, there was a lot of overlay that was built last year as well. I mean, should we be looking at reasonably lower numbers here? Is a lot of stress factored in the first quarter in terms of impairment? So these are, you given the situation, you'll continue to look to add on to those management overlays during the course of the year. And second question, in terms of, I mean, difficult to maybe answer on it may be premature, but in terms of sectors that are under stress, any areas where you're avoiding completely in terms of lending, areas that you're looking to lend? I mean, is there a sectoral, delineation in terms of, preference and avoidance on lending?
So I think generally we have certain sectors marked as high risk sectors. So you'll have construction, tourism, agriculture to an extent, and then import sectors as sectors that we probably might be a bit careful in terms of lending. So in terms of maybe focus areas, of course, would be exports and different sectors in exports that we'll want to drive at this point in time. So those are few areas that we will be focusing on. What was your first question, Murad? I think I missed it.
Impairment. So you built 6.8 billion in loan-related impairments,
So,
a lot of overlays.
definitely for ISBs, as I mentioned earlier, we might have to increase our impairment. We'll probably wait to see what kind of information that comes out with regard to the discussions with IMF. Based on that, with discussions with our auditors and central bank, we will then try to see how much of impairment we'll need to make. So most likely there'll be more impairments coming on ISPs, but on loans, we'll have to wait and see how the loan, what kind of bucket movements that we would see going forward, with interest rates being high, with inflation being high, now taxes being imposed. We'll have to wait and see what kind of impact would that have. But for the moment, and especially in the first quarter, you have seen that credit quality was pretty good. and we continue to focus a lot on ensuring that that continues. But if there is a movement, then we will have to, of course, come in and make higher impairments. Again, as you mentioned correctly, we do have certain management overlays, which we didn't reverse in the first quarter, despite loans under moratorium coming down to about 3%, because we wanted to keep it there in case the situation deteriorates. And in addition to that, we also brought in certain buffers through stressing the economic factor. And that also was brought in the first quarter itself, and brought in certain additional impairments into the collective model through the stresses in our economic factors. So we think we have built-in fair amount of buffers, but we are trading in unknown territory. So we'll need to see how things plan out.
Thank you. And just on the investment book, so as of last reported, you had about 168 billion odd in treasury bills, about 40 billion odd in treasury bonds. You mentioned that most of your investments are at the shorter end of the curve, so treasury bills would not be sub 1 year. But how's the maturity profile on the bond book like? I mean.
So bond book also is fairly low. I guess we probably have gone slightly into the longer end now with rates being higher, but still majority is in the shorter end. I don't have the duration of the bond portfolio right now with me, but I know that we probably started moving slightly into the longer end with rates moving up.
Sure. So what I just wanted to get was that there will be no drag from the bond book being invested previously at lower rates. So a lot of it is repriced to current rates.
Yeah.
Okay. Thank you.
I think we were probably almost 100% in treasury bills when rates were below 10%. And so that's why we have been able to ride that curve.
Thank you very much, Rajiv.
Thanks, Murad. Welcome, Murad. Any other questions? So if there are no other questions, thank you very much, everyone, for joining today's call, and we'll catch up with you all again with our second quarter numbers. Thank you very much and have a good day.